Hey everybody, welcome back. So, you see this guy here? Yeah. I don't know today what happened. I just know that the market got slaughtered. And if you didn't buy Tesla, then I don't know what to say. So, tomorrow will be a new beginning. It will be Friday. I hope it's not one of those red Fridays, but hey, it is what it is. We're here for the long-term investing. We're here for the long run. So that's not gonna change my mentality. So in today's video, what I'm gonna show you is the very basics of investing and what I do and what's the first thing I do to predict the future price of a company by looking at two things. Essentially, you just need two things. You could go to Yahoo Finance and you can get all the EPS and the earnings per shares. You can get like their financial statements. You can get the very basics of the numbers, which is what we're gonna use today because you don't really want to spend a lot of time reading those statements. Like there's like if you're an accountant, you probably don't know what the hell you're looking at. So let's keep it simple. Let's keep it very basic and let's learn a little bit, right? So I'm gonna take two examples today, Apple and Tesla. Those are one of my favorites. I keep putting money on this too every time there's a red day. So let's jump into Apple. So essentially speaking, there is a priority on the things I look for. So for 2020 and 2021, I use this for last year, but I'm gonna continue to use it this year, is I wanna look at five things, essentially speaking, five things. And then the last two I use for actually making a quick calculation. It's a very rough estimate. It's simply just three variables and you just can calculate based on what the earnings per share is that it's been estimated from the statements, from the financial statements that the company reported last quarter. So just so you know, a company reports every quarter they have to do their numbers. They have to, a bunch of accountants run a bunch of numbers and they have to pretty much put every single number, money coming in, money coming out, liabilities, which is like pretty much like how much money that I'm renting here, I owe money to here, this account, accounts payable, things like that. And everything adds up, and then you pay taxes, and then you have your EBITDA, and then which is like earnings per share before depreciation and amortization and things like that they have to pretty much account into everything. And there's a bunch of stuff that goes into these things, but we don't need to go there. Cash flow. A company that moves money in and out and they have cash capacity, that's number one. If you can keep that, if a company maintains a cash flow, great. I had this last year, COVID proof, but we all know that COVID's probably gonna go away, maybe. People are getting vaccinated, things have changed a little bit. So I still want to enforce this, maybe not on number 2, but number 4 or 3. But I'm really thinking what I said yesterday is for the companies that really are doing great right now, they're gonna continue to do great even when the economy opens. Like people think Amazon is gonna do bad because people are going out and things like that. I'm actually thinking Amazon's gonna do great like other companies because they invested so much money during the COVID that now they can keep their costs down because they're more efficient during the COVID times. And so that helped them. And I think their profitability, their numbers coming forward, that's gonna be insane. Growth. You wanna see a company that's growing percentage-wise. Like if you see a quarter, they're growing, they're projecting a growth of like 50%, 40% in revenue, and they continue that growth, that's a positive thing. If you see fluctuations in revenue, not good. The PE ratio, that's very important because that's the price per earnings. So like that pretty much tells you the ratio between where you're sitting in the stock and then the earnings, pretty much like how much they earned per share. And then obviously the earnings per share, but in the future. So a very high level summary here. I looked up, you can go to Yahoo Finance, right? You can put AALPL, you can put Apple, right? You look it up. And then you could see a couple things here, right? So you have, what's important here is pretty much this right here. PE ratio, right? Which is pretty much the price divided by the amount of shares that they have. So pretty much, if you multiply the amount of shares by this number that Apple has, like the entire amount of shares that they got for people to buy and sell, you get this number, right? So you multiply that, you divide it, and you take the number of shares and you multiply by this and you get the total market cap. So that's pretty much how much they got. It doesn't matter for this calculation. What matters is this, the earnings per share. So based on the last earnings and the current estimates that they got, this is pretty much, essentially speaking, their earnings projected per share. Like I said, they got a set amount of shares that they got. And so like they pretty much simply do that. So here's the thing. This is the enterprise, the market cap pretty much is calculated based on that. So that's just essentially what it is, right? The amount of shares times that P ratio, and then that gives you that market cap. But again, that doesn't matter. What matters for me right now is this numbers right here. So what you do is you go to analysis, right? You go to analysis and you could see it, right? So earnings estimate. They're estimating that this year they're going to have an average of 445. Keep that number in mind. Write it down on a piece of paper. 445. So 4.45 estimated earnings that they're going to get. So that number comes in handy because right now their EPS, it's 369 based on the current price of the stock. So our calculation here, okay, when we go back to this, the calculation says, and this is just me trying to do quick numbers, right? So you take the price of the stock right now, which is essentially speaking 120, right? So 120, you take 120 and you divide that guy by the current EPS. So that means the 3.69. That gives you a number, 32.5. And then you take that guy and you multiply by the estimated. Well, where you get your estimated? This one right here. So 445, that will be at the end of the year. Like you see every quarter, they have earnings per shares that are estimated. Then they add up on the 4 quarters and then you get this number. So 445. You multiply this guy by 445 and the estimated price of the stock would be 144. This is great because if the stock is trading above that number, you're overpaying this guy. You're overpaying it. It's crazy. Stupid to buy like that. But if you are below on the calculation at the current price, then you want to buy. You want to keep buying. You want to load up that truck. Because I think that's what's going to make you money, and that's what's going to guarantee that you sell high and not buy when it's really high and then you end up, losing a lot of money because it went down. So that's what's been happening with Apple. This means that it's on good territory for buying. Let's see if you keep it until 2022. Let's do that calculation. If you do the current EPS, so that's 120, so 121 divided by 3.69 times 468 times 468. This is predicting that Apple's going to be $153 next year. So think about it, right? This is why long-term investing is great, okay? And this is the magic behind it. Unless this company is projected to have a really shitty year, which nobody's predicting because obviously this is just estimates and a bunch of analysts that they know what the fuck's going on and they predict the growth. It's like amazing, it's great, the company's gonna keep making money, and who doesn't know one of these things? I mean, this thing, everybody has it, right? Everybody has an iPad, everybody has a Mac. Apple's not going anywhere. So you want to put your money on this company, and it's projecting 153 from where it is right now. So you're making potentially $30 to $40 on a fair price if you buy right now and you keep it for 2 years, which is what I'm going to do. I keep piling up on Tesla shares and Apple shares because I think the company, essentially speaking, is going to go to the moon, okay? Let's do Tesla, for instance. So Tesla, right? Tesla, you look it up in Yahoo Finance. Look that mug up. Now this one, I want to do this one because it's a little stupid, I think, because they really do not make that much money. But let's do the calculation and see where we at. So right now, the price of the stock is $6.82 after this, whatever, in the last 2 days, it's been terrible, like 5 days. I mean, it's like, it was $7.89. A month ago, it was $900. It's 30% now. But anyways, so if we look at this, right? We duplicate this guy. Tesla is trading at 682. So 600 and, well, let's do 668 because that's after hours. 668. I'm going to buy more tomorrow. You watch. You divide this guy by 0.64. That's pretty bad. If you go to analysis Okay, you predict. They tell you the actual average estimate. So that they're saying for this year is going to be 416. You multiply this by 416, and that gives you this. Now, this is high valuation, so really, I mean, I don't know, guys. I mean, I think this is just ridiculous, right? It's a really high PE ratio. Like, look at this, right? Like the market cap half this year. You know, it doesn't make too much sense right now, but essentially speaking, that's what they're predicting. So, you know, for the year, if you do 682 divided by, let's say the average estimate is 416, and you multiply this by, look at it, it was 582 back in when I did this calculation. And they're predicting an average estimate for the current year of 416, which I think it's high, but that's it, 682. It's actually not that bad. Like, it's exactly that number. So we're buying it at a fair, you know, price. So I think this is just a good example of what Tesla could do if it continues to be, you know, if it continues to go this way. Like if we do the calculation with just the current, not the year, so 682 divided by, what is it right now? 0.64. And then you multiply that by 0.76. Oh. There you go, 800. So right now Tesla is fair. Okay? It's a fair price. You know, this is fair price. So folks, you know, this is the very simple thing I do when I invest in companies. I look at the EPSs, but there's way more stuff that you can look. You know, the earnings, the EPS trend. You know, if it's been growing, which is growing. Everybody's recommended you buy Tesla. You know, it has good potential. You know, there's a lot of price targets. The average is 600. You can also look in here. So I use Yahoo Finance for a lot of stuff. I think that you got to do your own homework. Okay, this is the very basics I follow for any company I put money in. But I think that you know, if you have any questions, let me know. Again, you invest on the companies you want. You do your own research. You do the investments that you think are worth for you, and you put money on the companies that you really enjoy. So I think that this is one thing that I wanted to share with you guys, since a lot of people have been asking me about like the very basics of this. And you know, I think this is a good tool to have and understand the earnings per shares, the actual estimation that they're looking at, and how do you look at that when actually putting money in? Are you buying at a higher price? Are you buying at a discounted price? And is that really making sense for your investment criteria, in where you average in every time the price of the stock goes below that predicted target price? Again, this is just predictions, EPS change. They are estimations. They might fluctuate based on the projections, but it's a very good rule of thumb. So I hope you enjoyed this video, and let me know if you guys have more questions. See you later.